Tim Cook just announced on April 20th, 2026, that he's stepping down as Apple CEO, transitioning to executive chairman this September, with John Ternus taking over the top job. You just heard the news. So here's what most people are missing. Someone who put $1,000 into Apple stock in August 2011, the month Cook took over, is sitting on roughly $11,000 today. And that's before dividends. That's an 11x return over about 15 years for someone who did absolutely nothing fancy. And the lesson buried inside that number has almost nothing to do with Tim Cook the person, and everything to do with how ordinary investors actually build wealth. Let's start with what that 11x actually rewarded, because it wasn't luck, it wasn't a lottery ticket, it wasn't someone being a genius stock picker. When you buy a share of a company, you're buying a tiny slice of ownership in a real business. And your returns over the long run are tied to one simple thing. Does that business become worth more? So let's look at the actual business. When Cook took over in fiscal 2011, Apple's annual revenue was roughly $108 billion. By the most recent fiscal year, that number is north of $400 billion. The market cap, the total value of the company, went from around $350 billion in August 2011 to roughly $4 trillion today. That's almost exactly an 11x jump in what the business is worth. And wouldn't you know it, that matches almost exactly what happened to the stock. The investor got rewarded because the underlying company genuinely grew into something much bigger. This is the part beginners miss. You are not betting on a ticker symbol going up. You are buying a piece of a business. If the business gets bigger and more profitable, you get richer alongside it. That's the whole game. Now here's where it gets uncomfortable, because if the story was just buy Apple in 2011, become an 11xer, everyone would have done it. They didn't. And I want to walk you through exactly why. Between August 2011 and today, there were at least 4 separate moments where selling Apple felt like the obvious, responsible, grown-up thing to do. Moment 1, 2013. Fears exploded that China was slowing down, and a much bigger fear was hanging over every Apple shareholder. Could this company survive without Steve Jobs? The narrative was everywhere. Innovation was dead. Cook was a supply chain guy, not a visionary. Sell now before it gets worse. Moment 2, 2018. The US-China trade war. Tariff threats hit iPhones directly, and the stock dropped roughly 30% in a matter of months. Every headline said Apple was uniquely exposed. Sell now before it gets worse. Moment 3, March 2020, COVID. The entire market fell off a cliff, and Apple dropped around 30% in a matter of weeks. Stores were closing, supply chains were breaking. Nobody knew if the economy was going to function in 6 months. Sell now before it gets worse. Moment 4, 2022. Inflation spiked, the Fed jacked up interest rates, and growth stocks got crushed. Apple fell 25% or more. The narrative? The era of big tech is over. Sell now before it gets worse. Here's the thing. In every single one of those moments, the stock recovered and went higher. The investor who held through all 4 captured the full 11x. The investor who sold at any of those obvious exit points locked in a loss or missed the rebound entirely. And I want to be really honest with you. Selling during those drops didn't feel dumb at the time. It felt smart. It felt careful. It felt like protecting yourself. That's the trap. The moments that feel most like get out now are often the exact moments the long-term investor is being rewarded for staying. Which brings us to the boring habit that actually beats trying to time any of this. Dollar cost averaging. The idea is almost insultingly simple. You put a fixed amount in at regular intervals, say $100 a month, regardless of what the price is doing, regardless of the headlines, regardless of how you feel. Now watch what that does in the Apple example. An investor putting in $100 every month starting August 2011 would have kept buying in 2013 when China fears were loud. Kept buying in 2018 when the stock dropped 30%. Kept buying in March 2020 when everything was on fire. Kept buying in 2022 when growth stocks got crushed. And here's the magic. When the price drops, that $100 buys you more shares. So during every one of those scary moments, the dollar cost averager was quietly loading up at a discount. Their average cost per share ends up lower than someone who just bought a lump sum in 2011 and held. That means their return is actually better than the 11x. Not because they were clever, because they were consistent. They bought through the dips, not out of them. This is the mechanism almost nobody teaches beginners. You don't need to predict anything. You just need to keep showing up on the same day every month and pressing the same button. Now let's talk about the news that kicked this whole video off. Cook is stepping down, Ternus is taking over. Should a long-term holder do something about that? Here's some history. Apple has now had 3 CEO transitions in its public life. Steve Jobs stepped back in 2011 and passed away that October. Cook took over. And now in 2026, Cook to Ternus. The investor sitting on the full 11x from Cook's tenure did not need to react to the 2011 transition. And they do not need to react to the 2026 one either. In fact, people who sold Apple when Jobs died in October 2011 locked in losses right at the start of one of the greatest bull runs in stock market history. Think about that. The responsible move. The move that felt like respecting the gravity of the moment was the single most expensive decision they could have made. The business is the investment. The CEO is one person running it. Great businesses outlast the individuals at the top. And if you've done the work of picking a company you actually believe in long term, a leadership change by itself is almost never a reason to bail. Now, to be clear, none of this is saying you should blindly hold any stock forever. If the fundamentals of a business genuinely break down, revenue falling year after year, profits collapsing, the product nobody wants, that's a real signal. A CEO changing chairs is not. So let's pull it all together. The investor who turned $1,000 into $11,000 under Cook's tenure didn't do anything extraordinary. They didn't call the bottom of COVID. They didn't dodge the 2022 crash. They didn't predict a single product launch. They bought ownership in a business that grew. They held through 4 separate moments that screamed sell. And the boring ones who kept buying $100 a month through every one of those dips actually did better than the lump sum holder. That's the lesson that works in 2026, in 2030, and in 2040. It worked before Cook. It worked during Cook. It will work after Cook. Buy pieces of great businesses. Keep buying when it's scary. Ignore the CEO headlines. Let time do the heavy lifting. The investor who did nothing extraordinary made extraordinary returns by doing nothing extraordinary. That is the entire game. If this reframed how you think about holding through the noise, hit subscribe. I'm Joe, and I'll see you in the next one.